guess with athletes, quite often it's a limited period of time. Apparently OnlyFans might be the same. Banks are viewing it as there's no guarantee you're going to have this for your whole lifetime when they're assessing them for lending, even though, people have their kinks. But welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard. Welcome back to Slice Your Property podcast. Today we are joined by Kayne from formerly Money Empire, now Properli.
Good to be here.
Tell us a little bit about this rebrand, Kayne.
Yeah, so we've been sort of 10 years, I suppose, deep in the industry, trying to change the game a bit, and I felt that the brand had sort of run its own course where we needed to get to. And the next phase of probably life for our company was all about fully integrated property group. So really getting ahead, touching a lot of people along the way, creating outcomes for people. And the word properly came together from a combination of property and lifestyle, because we think that, I suppose, the lifestyle you want, you can actually get from property and property investment. And it doesn't have to be buying a house for a return on it. It can be a strategic move to buy a house to live in, knowing that over time you can make money from it.
It's also a pun, like buying property properly.
Absolutely. So we're all about being proper and improper around our culture, and we're trying to really embed that going forward.
Love it. Well, yeah, excited to hear more, but we will start the episode, as we do, with your first home experience. Can you tell us a little bit about that?
Oh, absolutely. So I probably spent 10 years offshore in Australia in financial planning, superannuation, managed funds, shares, property. So while I was offshore, I did a bit of trading and flipping on property. But if I talk about probably my first real experience was when I bought a house to live in, was closing on 10 years ago. And it wasn't really a true first home because I probably spent about 1.4 mil buying it. But it was really understanding and going through the proper process of due diligence. I obviously understood it from a finance point of view and knew what the outcomes were, but just getting a good team around you, I think, and making sure for me that I knew this wasn't my forever home. So making sure the purchase was going to make me money and work for me over time.
It's interesting, though, that you say, 1.4 wasn't your first home, though a lot of our first home buyers, or not everyone, but there are a fair few that do actually make that, higher entrant point. So maybe it's just the expectations that one has when buying property and that they want to spend a bit more. But it's interesting that you say, even then you wanted to make sure that 1.4 was not your forever home. So, what were some of your considerations when it came to making sure that property was going to work for you?
Location, looking at data. I'm big on data. So looking at, I suppose, data moving forward and seeing what those trends were, but also history, because we know history repeats itself. And probably the situation we're in at the moment, everyone thinks, but it's I suppose, dark times, but we know sun comes at the end of it, the next day, and life goes on.
The sun will come out tomorrow. That's from Annie the musical.
Absolutely.
I was in it when I was a child.
So, look, we're boom and bust cycles, right? So location, like I said, looking at data, looked at the rental market, the yield, schooling, transport lines and links, strategic growth, what was happening. So I'm very much in that way inclined.
Yeah.
So my wife hated that because she was all about just buying the home and living in it. But I'm
and
always
this one
about,
looks good, like.
yeah, exactly. But I'm about the big picture, how this can go.
Yeah, amazing. And I think that's such valuable advice, or foresight to offer to our first home buyers, that actually it is also an investment. So you do sort of need to treat it as such. Speaking of data insights, we were talking off camera before a little bit about what we're seeing, and I like it when you sort of validate where I've purchased a property. But can you tell us what sort of market insights you're seeing and which areas you think are maybe due for an increase in value?
So if I'm looking probably the Greater Auckland area, because that's where we're at the moment, you're looking at stock levels and you're seeing a lot centrally. So we're seeing a lot of stock on the market in the affluent areas, Remuera. There's a ton of them going on. We've seen a lot of stock come to fruition in South Auckland, a lot of new builds, which I suppose through COVID was brought up by developers, and there's been a lot of development in that space. So we're seeing that. Look, that also too will move through over the next 2 years. With consents dropping off, we're going to have, I think, another housing issue going forward.
Yep. And migration coming up.
Actually, rates will start to drop, so housing becomes more affordable again. We go through that cycle. But I do think there's patches on the shore that we were talking about just over the bridge. You've got Birkdale, Beach Haven. I really think some of those spots which are still well priced to get in and make some money from.
Yeah. So that's where I'm at in Birkenhead over there. And I sort of felt that trend, not felt, I did research. That makes me sound like real woo-woo, like I felt the vibe. But no, I did research into it and I did think those areas. So that was really where we focused. But there's some great deals over there now too. But also I feel like people don't realize it's 10 minutes across the bridge, like on a good day. Obviously not all the time. But your peak traffic is like maybe 35. It's not actually that bad. Whereas like coming south on that southern motorway.
Absolutely. I mean, we were talking about it, right? It's you kind of either born this side of the bridge or that side of it if you're from Auckland, and you don't tend to cross it. But from an investment point of view, I think it's a huge opportunity. I also think Christchurch, the Selwyn district, huge. Like we're seeing a lot of our client base purchase down there for investment opportunities. Standalone homes for around the 750K, brand new 10-year warranties, yields of 4.5%. So there's a lot of
lots of opportunity.
You've got Queenstown still really strong. So when you're looking outside of Auckland, they're your kind of areas that you're really going to, I think, focus on it and go harder.
When you think about Christchurch, though, and like EQC, the earthquake, commission and challenges there, is that something that you factor in?
Yeah, you do, but I think, look, the building codes have changed from what we've seen, and so you're just building better to execute an outcome that if something does happen, like an earthquake, that at least there's protection in place. So there's issues there, but you just got to get your DD done with your lawyers on that as well.
Yeah, definitely, and we can support with that at Slice. Talking about Properli and the property life cycle, as you put it, like it's not just a one purchase, it's an ongoing experience. What is it that you guys try to do to help people move through that?
Yeah, look, I think the big thing is if we focus on the first-time buyer is all about getting their first home. They're not thinking 10 years down the track all the time because it's such a big emotional purchase and it's draining. One, from your bank account, two, taking out a mortgage, and then three, going, well, geez, I've got to pay all my bills, plus I've got to fit this place out. So you've really got to think, we'll try to get our clientele to think differently in that space. And a lot of the time, first-time buyer might come to one of my advisors or our team and say, hey, look, I'm wanting to buy my first home. I'm born and bred in a suburb that X amount where it's a $2 million home.
Yeah.
And we might change their thought process and say, well, if you're really happy where you're renting, why not invest in a property rather than going something to live in? So trying to change that mindset. But I tell you, the power of property around leveraging is incredible. It's not like you can put $10,000 in your bank account and leverage that and double your money and put it elsewhere. And that's the power of property where you can really build wealth. So it's about the stepping stone and paying down debt, creating equity through capital gains and leveraging that.
Yeah, totally. And I think what's really interesting about that, the mindset shift or managing some of those first home buyers' expectations is that there are these other options. And I think people just think, oh, but I can't afford in Remuera, so I can't afford anywhere. By the way, there's actually some great deals in Remuera at the moment, but it is mindset rather than going, actually, perhaps I could purchase over here and then rent it out. Now, I'm starting to talk about this quite consistently, but I think it's interesting because, yes, you might need a 35% deposit for an investment property, but actually you could use your KiwiSaver, you could buy a first home, you could live there for 6 months and then rent it out afterwards. So there's lots of different opportunities that might be available to you, even if you do want to, keep renting in Remuera or wherever it is.
Absolutely. And don't forget, new builds are exempt, right? So you can buy with 20% or even higher or lower, deposit for an investment property as well.
Yeah, so that's another thing that, we need to do a bit more of in terms of our content online, I think, is actually showing through some different developments.
Yeah, so we've got developments. We do a few developments ourselves where we'll focus on property investment stock for a lot of our client base. And so it's all about people that have a family home with equity, leveraging off that and trying to achieve a 4.5% yield, and a new build with lower deposits from equity, higher yields. So when interest rates start to balance out, these properties become cash neutral and you're getting capital gains. So a lot of the time people will buy an investment property to actually pay off family debt or your owner-occupied debt down the track with capital gains. It's just a time. You just got to invest for time. It's not quick win.
Yes, you got to be in market, over time. It's a 10-year cycle really, or so it has been to date. And yeah, what sort of challenges are you seeing in market at the moment? I think, you're close to the development side as well as the purchaser side. How are you feeling developers are managing during this tricky, I guess, market, and also what are you seeing in terms of purchaser interest?
So I think if I talk on the development space, obviously building costs went up quite a bit. They're still quite high, but they are starting to even out a bit with the flow of excess of products. Land acquisition has been quite skewed because you still have vendors wanting those COVID prices, cost per square metre. They are starting to taper off. So when you're developing, it's all about creating those at the right numbers to execute at the back end, because you can't oversell an overpriced property because it won't sell on the market. So you do have those issues, but good developers are still doing stuff, and they're actually buying stuff up now because they can see the opportunity of what's going to happen, and I'm sure we'll touch on that. And from, I suppose, the purchasers or buying point of view at the moment, you do have a lot of people in the market, people with really good incomes, and aren't scared by probably the higher interest rates, because you can buy undervalue at them, or not undervalue, but at a good value for what we think it is.
At a good price, right, which is likely to increase in value.
Absolutely, but I do say this, and I personally think that with what's going on, we've had building consents really drop off a cliff, high migration because of COVID, and I do think once interest rates start to come down over the next 24 months, we might hit another issue around housing and supply again, and that's what we don't want, because that forces prices up.
Yeah. And I mean, that's where you need developers, you need development to occur. Otherwise, we just go through this repeating cycle of demand versus supply, and people bidding the prices of those properties up. Into that development piece, because, yeah, you mentioned people are starting to get back in and get a bit gunny. I mean, a year ago, if that, developers were selling off and trying to get rid of just land that they might have bought that they could have subdivided and built 2 properties on, or whatever. What do you think have been the key factors that are shifting that mindset?
It's still happening. It's still happening. There's developers out there that are trying to offload because they bought way too high.
Yeah.
So the cost per square metre that they bought it was too high to even execute what they need. But I think the good developers that have capital and cash are ready to go. They're sort of buying up land now.
And seeing the opportunities, yeah.
To get resource consent, building consent, EPA, it might be 6 months in this environment from council. Once that issue, they can start building. So they might come to market in 18 months' time. So I think we're then playing in a completely different market to what we're at now.
Yeah, totally. And on a buyer side as well, let's talk about that, because I feel there have been some opportunities with developers, and as you said, some that maybe did make the wrong purchases still selling. What opportunities could buyers be looking for? Because there may be, subdividable options out there that they can pick up for a steal.
Absolutely. So I think from a buyer's point of view, there is opportunities in this market everywhere, whether it's an existing home on a plot of land, or a new build that a developer's trying to offload and undercut just to get out of the development itself. They're out there. You've got to look hard, and you've got to really look at data or
look at the numbers as well.
Look at the numbers for sure, because I think if you're buying, you need to understand what your carry costs are on that. And what I mean by that is what your repayments, your insurance, your rates, all that kind of stuff. And are you going to live in that house, or are you going to have someone contribute to that mortgage being a rent?
And how much is the rent going to cover? So what is the estimated rental? Can you rent by room? Or if you're moving in there, can you bring a boarder in? How can you manage the costs over time?
Absolutely. So again, I'd say to buyers, if you're quite a novice in that space, if you're going to buy an existing home with some land and you think you're going to subdivide or put another dwelling on it, you've got to really understand how to do that and what your costs are, because I have seen people get into a lot of trouble with it.
Yeah, and it might be a later, not now thing. It might be, oh, actually, yeah, there's a house on it, but the section could be subdivided. We can do that when we've got money down the line, like particularly if a first home buyer's looking at it.
And I don't think, to be honest, I don't think most first home buyers actually look at that. They just look at it getting a house and getting into it, and then over time they might just trip upon that, and someone mentions them, so they look into it. And I think if you go with that attitude and just understand what your upfront costs are and not think about the potential future, I think you're okay.
Yeah. But also, if you can think about opportunities to grow your wealth, you level up and you put yourself in a totally different position.
I think no one sits here and says, I want to be poor.
Yeah.
We all want to have some sort of lifestyle, whether that's luxury or you're happy with how your life is. Everyone wants to be comfortable.
And I feel that the anxiety, yes, it comes around the emotional element of buying, but it is also because people know that's a big amount, for most people, it's their biggest purchase, it's their biggest investment. So they are aware that there's a lot of money going into it and they do want that money to work for them. So I think we can give them some credit that they're aware of that. But yeah, I guess it's just you don't have to do everything on it, but do your due diligence and do think about it as a bit of an investment. Don't just think about it emotionally, I guess, because it's easy to do.
I agree. And make sure that you're looking at, you're getting the builder report, you're looking at if there's any maintenance on a house, does the roof need to be repaired at any stage or replaced? Because these are things that are going to cost you 20, 30K at some point.
Yeah, we're going to need it to our roof. Yeah, there you go. But the building report said it wasn't that bad. But anyway, yeah, I think the thing is you do want to make the best possible decision you can, right? And right now you have the time you have the luxury to actually do that due diligence with a lot less pressure than you did 2-3 years ago, where you had like 2 days to get everything done, make an offer or go to auction. Like now people have a lot more time to do that due diligence.
Actually, like you touched on is that what creates pressure and people don't do the natural DDs when a lot of properties go to auction, because people don't want to spend money up front if they don't know they're going to actually get it. So you find they don't do their DD, they don't do maybe get a building report or do the actual needs to understand what those outcomes could be.
And auctions are there to bid the price up as well. So they're not always the best outcome, particularly for first home buyers. But, you are beholden to the market that you're in. But right now, it's not really an auction market. Cool. And in terms of your property portfolio or experience investing in properties, what has that looked like?
Yeah, so again, like I take nothing on or try not to take as much on emotionally from it. So whether it's trading, buying and holding, leveraging and then using capital to get into other stuff. So I've been really focused on the development side of what we're doing and really building that up and try to bring some stock over the next, especially over the next 24 months to market. But probably touching on my original point, it's always looking in growth areas or opportunities to make some long-term money and capital gains. And, I've never been scared to take on what we call good debt. So debt which is going to upskill myself as a person, but also to my assets and my portfolios. So it's all about that. And then trying to diversify at the back end, so you're not getting hedged into one asset class. We talk about this all the time, but, property, KiwiSaver, cash. A lot of people get into shares now, like for sharesies. So just trying to diversify a little bit. I do realise at a young age, you mostly do all go into property because you need to put your resources into it.
Yeah.
But over time, you can kind of diversify in that space.
Yeah, totally. And I think property can be a good initial step because it gives you that leverage. And then, you can use your equity to do other things. You can start investing in shares. You can, do lots of different things.
Well, we always say this is that you might see someone with, 50 or 100 grand in their bank account wanting to buy a property, but they do nothing for 2 years because they're waiting for the right time. And markets move, and normally a market in that time probably goes up by 5%, and you can't save enough to continue that market.
So your 10% deposit or your 20% deposit is now a 10% or a 5% deposit in 2 years' time. I mean, obviously the market changes year on year, but yeah, that's the danger, right?
Yeah, absolutely. And people try to wait for the perfect moment, but there is no perfect moment. If you've got the opportunity, like I said, if it's a home that isn't your forever home or your ladder in life, then look at it as an investment, even if you're living in it, because you're actually moving on a market and a ladder.
And then also you can, just don't necessarily look at it year on year and be like, oh, it's made this much or it's lost this much or whatever. It's like, just leave it. If you're not planning on selling that year, you don't need to look at that so closely.
That is the one bad thing about technology, right?
Yeah.
You can look at your property value every single day now because it's either attached to your bank account or people got logins through CoreLogic or whatever, and they will look at it at a daily value rather than maybe every time it's sold back 10 years ago, you know? So people do get stuck on that.
Yeah, and that creates anxiety. So just set and forget, I think, until you go to sell, particularly for those that bought in the last 2 years, myself included. You obviously have your own podcast and support a lot of athletes with their careers. So it's a bit of a sidetrack or pivot. But yeah, what do you see with people trying to manage their finances that come into a lot of money really quickly? Because I think that's a really challenging thing, definitely for athletes, but for a lot of people, it's like you have nothing. That money mindset is, your money mindset, and then you come into it, and how do you support athletes or other people in that sort of situation?
Yeah, it's actually a really good question and topic, because whether you're an athlete or not, some people make a lot of money really quickly, right? And you could be 19, 20 and either a job or through software development now, these people are earning a lot of money, or through professional sport, they could be signing a contract with 200K at the age of 20. And that is a lot of money for a lot of people. So I'm all about, what does short-term, medium-term, and long-term look like? And we really put this through our company and our advisors, through people, but it's about tying money up. Honestly, it's about tying it into something tangible. And most people will buy a property because they can see it, they can feel it, they can smell it, and it's tied there, and they can drive past and say, hey, I own that. The share market and managed funds is a bit more convoluted, so people need a lot more advice around that. So we'll try from a young age, these people that will sign good income jobs, we'll try to tie them into a property and then get them to pay down debt as fast as possible. And then at any given time, leverage off that and buy another one. And so, if your career is lucky to be enough for a 10-year window in that sport or division or what you're in, if you can buy every 2 years and come out with 5 properties, by the end of that, you're actually set really well, because your equity levels, your LVRs or your debt to your income ratios on that, and it sets you up for the next phase of life and what that may look like going into new industry or whatever.
Yeah, so actually it's just using that money in an investment kind of focused way so that it can start to earn money for your future self as opposed to your current self, which, and it might be, I guess with athletes, what's interesting about that is that quite often it's a limited period of time. Apparently OnlyFans might be the same. The banks are viewing it as there's no guarantee you're going to have this for your whole lifetime when they're assessing them for lending.
That's actually really, I know other companies have come across it, but it'd be really interesting to know how that's looked at.
Yeah, so it isn't necessarily looked at as, okay, we think you can earn this until you're 50, even though, people have their kinks, but yeah, so it's interesting though for those people that might be really high earners for that period of time, and it is really about protecting their future through investment. So
You don't want to tie someone up in debt so that if that income completely stopped, it's around an exit strategy. So, okay, cool. In 5 years' time, what will my debt levels be? And then what will my income be to support that? And, most of guys and girls that come out of professional sport, it might not be that, hey, I want 100 grand to live off now. It might be that I want all my assets and investments taken care of, where the income covers the outgoings, and I can go start my next phase through a job, and that supports my living style.
yeah. And on that note, why do a lot of athletes move into property? They totally do though. I've seen so many of them move into become a mortgage broker or
I think because, probably throughout their career they had invested in them. And that's guys and girls now, because the females in the sport are really earning some good money and doing some really good stuff in that space. So it's probably because they bought a property, they've maybe paid down some debt, leverage, and then bought an investment or two. And, if it's through our company, we're pushing hard for these guys and girls to be, like I said, 5 properties in the back end when they're finished. So they do have something, and we're trying to gear it so they got 50, 60% equity in these properties. So there's a lot they can do. We want to educate people along the way too. Yeah. Because if you're just executing, telling people what to do all the time, what are they going to learn from the back end of it? Probably where it gets to. They might think that's a natural transition. I know this now, so I'll get into this industry, and you do see it a bit.
Yeah, because I've seen a lot of that. I've noticed gone to, NZ Home Loans and seen different people going for their mortgage brokerage and been like, oh, next to, I can't remember who it was, whether it was Mandona or something, but I saw definitely a rugby player in there. Do you work with a lot of athletes? Because I remember the podcast having a bit of a focus on that. Yeah.
We deal with a lot of professional rugby players, professional cricket players, some hockey, soccer. We've got good relationships across the board there. So, we have a big database of guys and girls. It's good to help these people out, because you want to see them end up with something when they finish, because they've dedicated a course for so long what they know, and to come out with something at the back end, because a colleague once said, who was a professional athlete, once said to me, the sport owes you nothing when you retire. And
you mentioned the 50 to 60% kind of equity goal. How do you kind of help them get to, whether it's athletes or whomever it is that's come into money and trying to build a portfolio to sort of support them over time? What are what are some strategies that you kind of deploy to support them into that?
There's two things, right? Through time creates natural gains or capital gains. Tie it up early, because we have had people come at the back end of their careers where they might have 2 years left in a contract and they're done.
So to extend on that, I guess the other risk for some younger people is that they may or may not have insurance or protection, for future self and their future wealth. What is your view on insurance for young people, and what can people be considering?
Yeah, I think insurance for a lot of people is a dirty word. They think they pay a premium and never claim on it. We just got to if we look at tangible insurance, so fire in general, and the recent events of floods and cyclones, people have lost everything: houses, contents, cars, everything. And if you weren't insured, which I know a lot of people that were renting weren't insured, so their contents was wiped away, you're left with the bill.
I know some that actually settled on a property, and the period between settlement and them having insurance meant that they lost their entire house. So you also, if you're buying, you need your insurance to start, the day before settlement. Like, you need it lined up, because you can't take that risk.
Personally, our family home was flooded in the floods, and so we had to move out, and I can't tell you how fast it happened too, in terms of the water coming up the level. And, our contents was wiped out. So we claimed on about 80 grand worth of contents.
Wow.
And then we actually, because we're in this industry, I had really good insurance where it paid me 6 months out of rent to go rent somewhere. So, that was another 60 grand. So effectively, I'm 130, 140K in a hole if I don't have insurance. Most people do not have that on them, right?
Yeah.
So making sure that kind of stuff is really insured correctly. If you're buying a house, obviously everyone's like, well, I need insurance for that. I don't really want it because the bank needs it. But,
need it.
Oh, absolutely. Just think if it burns down, right? And the replacement value on that. But probably the last thing I'd say is the most important is, we've always said this to people. We ask them what their most important asset is. And I know it's cheesy, but most people say, my house, because that's what they see, they feel is big, right? But, their most important asset is actually themselves. Because if they can't work and have the ability to earn income, how can they pay for that house? How can they pay for the food on the table? Anything. And most people go, ACC will cover me. But you've got to understand the ins and outs. So I've been there, done that at the age of 27, got really sick. I actually got cancer, and they had all their own insurance in place. So
I'm so sorry.
I know how that works, right? And I'm one of the lucky ones. It was fine in the end. But, you get big payouts to cover these. And I was actually starting a business at the time too. So it's a big difference in what needs to happen and then what your outcomes can be. So I'm huge on insurance, because I used to think I was bulletproof, but thankfully I had all the right covers in place. And I think people do need to really think of the worst case scenario.
Scary note to finish on. Let's flip it and ask you our final question, which is, if your first home or current home you choose had a doorbell and that doorbell played a theme song, what song would it play?
Oh, I reckon Batman.
Batman.
Yep. Yep. And that's for my girls too. They love Batman.
Oh, that is so lovely. Thank you for joining us, Kayne.
Awesome. Thank you.
Thank you for joining our community. Buying property isn't easy, but listening in will get you one step closer on your journey. Please leave an Apple or Spotify review and provide feedback so we can improve your experience. Join our Facebook group, A Safe Space to Learn Together, or follow us on Instagram at @slicetobuy. If you have any questions or topics you would like us to touch on, you can email us at hello@slicetobuy.com. A quick reminder, Slice the podcast does not provide personalised investment advice. We are not acting as financial advisors or taking into account your circumstances. To get personalised advice, join us at slicetobuy.com and engage with our partners who can act as your financial advisor or lawyer and support you with your specific needs.